Happy Friday, everybody. This is John Rothe at Riverbend Investment Management. Welcome to our Big Picture Weekly Market Update. This is for the week of September 30th, 2022. So talking about what's been going on in the market, I want to talk a little bit about market strength right now, where some of the trends are. This is our market strength matrix. And what it does is it represents our short-term and long-term indicators. And I like to tell people to think of this as really like a stoplight, where red means stop, green means go. And you can see here, we just have a lot of red across the board. The only area that's showing any interest is our stochastics indicator. This represents very overbought or oversold levels in the market. And you can see we're very oversold right now. What's to take note of, markets can stay oversold or overbought for quite a period of time. So just because something's oversold doesn't necessarily mean it's an immediate buy. But it is something to keep an eye on. And if we see any type of confirmation within those momentum indicators, it might be the start of some type of move a little bit higher. But if not, it's really just an indication that this is a shorter term bounce if it occurs, just to relieve some of these overbought conditions. If we look at our various sectors within the S&P 500, same story, just a lot of red in those momentum indicators. Short-term areas are oversold. And again, we might see some type of short-term bounce. But just right now, just there's not that momentum to indicate that there's any type of follow through within the market. This is areas versus cash, and this is a driving force within our portfolio models. What this represents is momentum versus cash, and we always want to own areas that are stronger than cash. We never want to own anything that's weaker than cash. And what this is a list of about 140 ETFs we follow that represent pretty much all the areas of the market, whether it be short-term, long-term bonds, international components, sector ETFs, pretty much anything you can think of. And what we notice here is this green area represents areas that are performing better than cash. What's doing better than cash? Only these inverse ETFs. And if you're not familiar with inverse ETFs, they do the opposite of their underlying components. So for example, this is a short S&P 500 ETF. So as the S&P 500 index goes down, let's say 2%, this ETF would be up 2%. So it does vice versa, basically the opposite of that index. And these are the only areas that are stronger than cash within this universe right now. And that's actually a bit rare. Usually you'll see some type of defensive component, whether it be, for example, utilities or consumer staples, for example. But right now, we're just not seeing any strength within any areas within the equity market, which is a bit rare. It's really an indication that not a lot of people and there's not a lot of movement and momentum within these individual sectors within the S&P 500. This is a visualization of basically that same concept. These are relative rotation graphs. And what they do is they typically rotate in a clockwise fashion. In this green area up here, this is our strongest area. So this would be our strongest area versus cash. And we always want to own things that are up here because they're outperforming cash or the strongest areas within that universe. And you can see here, all the sectors here are just in this weakest component here, this weakest quadrant. And anything that's down here, we never want to own. And you can see here, this is really where all the market is right now, all those sector components. And we keep an eye on things like technology, consumer staples, for example, because they are starting to trend upward toward these stronger areas in the market. And this might be an area that might start to improve, at least short term, depending on what the US dollar is doing. And I'll talk about that relationship in just in a second. I do want to talk a little bit about volatility first. This is the VIX indicator, and what this represents is volatility within the market. A lot of people like to refer to this as the fear gauge. And what will typically happen at the bottom of a market cycle is you'll have this event that causes a lot of fear and panic within the market, where everybody just wants to sell out of their portfolio regardless of what price. They'll sell at any price basically. And this represents that bottoming process where basically you literally run out of sellers within the market and the market starts to rise back up. But you can see here, these are past events. This is that 2008, 2009 cycle. This is that COVID cycle. These are areas where the market was really down more than 10% and had some type of shorter term event that caused a lot of fear in the market, and then the market started to recover. This is where we are right now. You can see we're really nowhere near these historic levels where there was a bottoming process within the market. Investors seem very compliant with what's going on, which I think is a bit unusual considering how far down equities are this year so far. So again, for some reason, people are very compliant with what's going on, and we really haven't had that fear component kick into the market yet, which might indicate some type of bottoming process. Now, it's not necessarily means we have to have that. We could just slowly have this longer term bear type market cycle like we had in the 70s, where you just had a lot of bigger long term ups and downs within that period of time. Or we could have some type of singular event here, which might be more related to inflation and what the Fed does that causes that panic within the market. So what are we doing with the portfolios right now since we're not holding any type of equity positions? Short term, we're just keeping an eye on these shorter term interest rates. This is, for example, this is our 2-year treasury rate. It's a great place for us to wait out some of those momentum indicators because it is yielding about 4% right now. So in terms of shorter term interest rates, they are looking a little bit interesting right now because, again, they are providing something to at least keep an eye on, at least something to park some cash on in short term. And this is really where a lot of money markets get their yields from as well. So again, just something to park cash on the sidelines while we wait out this and wait for some type of changeover to reflect that there's some positive momentum coming back into the market. This is our S&P 500 index. If you remember, I've been talking about this red triangle pattern for the last couple of weeks, and this really is just this downward trend versus this upward trend in the market, and eventually one side wins. And what happens is you have a lot of short-term traders that will bet on one side or the other side, and when they're wrong, they have to reverse their position, which will cause a longer term, more of a significant move in one way or the other. So remember this triangle pattern because I'm going to refer back to this in just a moment. But in terms of S&P 500, we obviously had that breakthrough below the triangle pattern. We are really rotating, kind of testing this this bottom that we had earlier in the year here, where the market's just really trading sideways right now. Again, not a lot of conviction in the market. Some potential targets we are looking at is this 50% retracement level. This is 50% retracement from the COVID lows, which a lot of those algorithmic traders like to focus on. But I think here is a potential area that we might be really talking about, since it is so close to this 50% retracement level, that people might want to bring the broader markets down to these pre-COVID highs that we had here in the market, really just erasing this COVID rally that we had in general. If we look at the small cap area of the market, it's already broken that level. We're trading back down again, but around those earlier lows that we had. And again, just really trading along this pattern here, not a lot of conviction to go up or down right now. We look at our value area of the market, value is already broken through that level. It's broken through that earlier low that we had in the year. So value is starting to show some weakness here in the market. It might be an early warning sign that the rest of the market's going to follow this scenario, but we have to keep an eye on that, because if we look at growth stocks, which are mostly our technology stocks, it's holding up a little bit better. We're back down to those earlier highs that we had in the year here, but here's that pre-COVID low, that pre-COVID high. So if we're going to erase all these gains that we had during COVID, we're going to have to start seeing some significant decline in these technology components of the market, which seem to actually be holding up a little bit better. So here's Apple. Now, if you remember, Apple is the largest component within the market right now, within the S&P 500. So it's the largest individual stock. And it's actually been holding up fairly well, especially compared to some of these other technology stocks like Netflix or Facebook, which have absolutely got destroyed this year. So while Apple is down for the year, it is holding up a little bit better, but we're starting to see that same type of triangle pattern form. And if you remember, really just you get that coil that starts to happen as people bet on one side or the other, and when it breaks through, you typically get that significant move higher or lower. So we might be starting to look at testing these. If it breaks through, start to test these these earlier lows we had. But again, here is that pre-COVID high here, and this might be the last holdout. These are those leadership names within the market that are really those higher weighting components in the S&P 500, which are really in everybody's portfolio. So if you own any type of mutual fund, you probably have Apple in it. So as people start to fear the market and start to, again, dump their funds at any price, you'll start to see these leadership names start to really come down aggressively, which might be that final trend that we have in that market, indicating we're in that bottoming cycle, that bottoming part of the cycle. Again, not necessarily means it's going to happen. We could have some good news come out on those inflation numbers as they start to come out, causing this market to start to rise up again. But we really want to keep a close eye on these leadership names, because they can give us an indication of what's going to happen next within the market. So really, a lot of these trends have to do with the US dollar, and the dollar has been rising over the year, and you can see there's been this inverse relationship with the S&P 500. So every time we've had a rally in the dollar, it's really penalized the S&P 500, especially technology stocks. right now you can see this US dollars in this nice rising trend, but it is overbought right now. If we look at our overbought indicators, it is overbought and starting to pull back a little bit. It does have positive momentum still. So as long as that momentum is in place, we might just see a reversal back to this trend line before it starts to resume its upward trend. Now, if you remember, we had this area of technology, the technology stocks starting to approach these areas where they start to outperform cash. So if we see the US dollar start to come back down a little bit, we might get a bit of a short-term move in the technology areas, because that's been the area that's really been, I think, moving the highest in terms of correlation with what the US dollar is doing. So keep an eye on that area of the market, because again, that might be some area we might have some short-term strength in. If we eventually do get a breakdown in this dollar trend, I think that's going to help the market start to rise and recover a little bit more aggressively. But when we zoom out a little bit more in terms of targets for the dollar, a lot of investors are looking at this previous high here going back to 2000, the dollar, and we're getting closer and closer to it. And then the worst case scenario is we start to approach these levels where we had just really high interest rates during the 80s after that inflation cycle. I don't think this is going to happen, because what's been happening as we've been getting closer and closer to these previous highs here is we're starting to see some international central banks step in. If you've been following the news, you probably heard about the British pound just getting absolutely hammered compared to the US dollar over the last couple of weeks. And now their central banks have stepped in to help stabilize their currency. So if we start to break through these levels and start to really see some significant spikes in the US dollar, I think you'll see more and more central banks step in to try to stabilize their currency, which will bring that dollar value back down. So two potential scenarios we're looking at. One is this 2008, 2009 scenario. This is really our worst case scenario. So what typically happens within these markets when you have these downward trends is you get some type of strength coming in at the end of the year. And so usually October, most of the times October, sometimes November, you have really this early bottoming process, and then you get that year-end rally. And then you finally, in 2008, 2009, we've had this final bottom process in 2009. Now, what might cause this type of scenario is that we start to get that year-end rally in the market, but inflation data stays sticky and it doesn't improve at all. At that point, I think the Fed has to start getting very aggressive, and we start talking about those higher interest rate levels, something similar to what we saw in the 80s. And that would really drive this market, I think, a lot further down to a point where the Fed would have to step in to stabilize markets, and just the Fed, I think, would make some type of big mistake along the way here, causing the markets to really panic. I think this is a little bit unlikely, and I think we'll start to see some type of improvement in some of the inflation numbers, hopefully, as we go on over the next couple of weeks and months, which leads me to a more likely scenario. This is the 4-year presidential cycle. And we really like to look at this as an idea of where the market might be leading next, really where the longer term trends might be going. This represents an average of all the years going back to 1971. And what historically happens is this midterm cycle, which we're in right now, has always been the weakest area of the market in terms of this 4-year cycle, with this pre-election cycle trend that we're about to enter it has been the strongest. As you can see here, the market has been really following this. What's more important is the trend and not how these lines match up. I could take the axis over here and move this red line up or down or wherever I want. It's more important that where that movement and where that direction is. And you can see here we might be in this bottoming process that we typically have, and have that strength come in the fall months. So we might see some type of bottom happen in October, and then start to begin to see that rising trend as we enter that cycle. So there might be some very good opportunities here for people that are sitting in cash to take advantage as we start to see improvement in momentum, where we can start getting in these trends fairly early and just take advantage of that rising trend as we enter that pre-election cycle. So I think this is going to be the more likely scenario that we start looking at, unless we see inflation data start to really get bad. And if we have some inflation numbers over the next few weeks come out where they're worse than expected, that could be bad for the market. But if not, I think we'll start to see some type of, again, early bottoming process within October, and then just start to see that move higher. So keeping an eye on those momentum indicators, because we do have a couple different scenarios to look at, which are potential possibilities for what might happen in the market over the next couple of weeks, the next couple of months. But really, I think it's not a good idea to speculate on this market. I really like to look at where the data is pointing and where the strength and those indicators will support us. So we want to, again, keep an eye on those levels to see what areas are starting to improve versus cash, and take advantage of any areas that to start to show stronger momentum than cash. So that's really what we're doing right now. So for now, just parking cash, short-term bonds, and waiting for some of those momentum signals to indicate that we might be starting this rising trend, which might happen in the next couple of weeks. So that's it for this week. Again, if you have any questions, please feel free to reach out to me. They're usually the fastest and quickest ways by email at john.rothe@riverbendinvestments.com. If you're on Twitter, you can check me out at John Rothe. I post more daily charts and things that are a little bit more technical in nature. But if you're a fellow finance geek and you like to follow those things, check me out on Twitter. So hope everyone's doing well. And again, if you have any questions, please feel free to reach out to me. So that's it for this week. Bye-bye for now.